Well, welcome everyone. We're going to give just a few seconds here as folks populate on the call. And we look forward to sharing some information. So let's just give it a few seconds as folks come on the call.
I need some background music playing.
Yeah, or something, right? All right, well, we're going to go ahead and get started. We appreciate everybody joining us today. It's our first webinar of the year. We did not do one in December, but we are excited to be back with you today for our first of the 12 we'll do this year. My name is Greg Patterson, and I'm joined with my colleagues, J.A. Canady and Tara Gould, and we are with Atlantic Wealth Management here in Morehead City. And we trust all of you had a wonderful holiday season. I know we did. We got some time off between Christmas and New Year's and just had a great time. But we are excited to be back together again, and we've got a lot to cover. There's been some legislation that has passed the end of the year, and so we're excited to bring that to you, as well as a market update. So and we've just got a few short minutes together, so let's get started. As in past broadcasts, I want to remind you that if the signal goes down, and it's rare that that happens, but it has happened, so we'd just like to address that up front. If it does go down, just hold your places. We'll be right back with you just as soon as we can. Also, if you have questions or comments, or you just want to send us a message along, you can do that to Mackenzie@myatlanticwealth.com. And Mackenzie will be grabbing those off the email. So that is MacKenzie@myatlanticwealth.com. We're welcoming any questions, feedback, comments. And if we don't have time to respond to you today, we will get back in touch with you. So lastly, we'll be doing these calls on monthly intervals towards the end of the month. We invite you to tune in. You will get an invitation to these. You'll see them on our website and social media. It is also a great way to invite friends or family members that you know could benefit from this. By all means, just forward that invite to them, and they can jump on the link and tune in to the broadcast, hear what we have to say, and any action items that come from the call, and we would welcome that opportunity. So with that, let's get started. And the first thing I think is important is just looking at what we'll discuss today. First, we're going to go over current market returns and just see where everything finished for the year. We're going to highlight some major market indexes and provide you folks with those total returns and share some insight on that, as well as give you an insight into the latest U.S. economic data, where we are to date. We always share the recession indicators dashboard. That seems to be a word that's bantered around more now than ever before. So we're going to talk about that. We'll also briefly speak about the debt ceiling here in the US and share some information around that. We will talk about economic and market summaries, really just giving you some highlights on what we think has taken place. We'll share 2023 retirement planning, and then we'll address the new legislation that came to be with the Secure 2.0. And so we'll highlight some of that legislation. There's a lot to it. We won't go over all of it, but we'll highlight. We've really cherry-picked some of the things that we think would be beneficial to our listeners today. And that will be enough. I think that'll be a lot for all of us to digest. So with that, let's dive right in. We've put a graphic up that just highlights several of the indexes, as well as gold at the bottom. And I think the important thing to note here is that all of these were negative. In fact, the only sector that was positive was energy. And then among the asset categories was cash. Cash was positive, although not by much, but it was positive. But we wanted to highlight these for you just so you get a sense of where we finished the year. And so we'll start with the S&P 500. This is the broadest measure in the US of the equity markets, and it finished at 3840. It was down 18%. The Dow is the oldest index. but probably not the best representative of the equity markets, as it only covers 30 US stocks. It's across some major sectors, but it was down 7%, largely due to the impact of energy. So that's why that was less of a decline than the S&P 500. But nonetheless, it was down at 33,147. Still a big number, mind you. The NASDAQ is down for the year 32%, almost 33. This is due largely because of the tech influence, and that was the biggest sell-off last year was in the tech space, and growth companies really felt it. They had the best year in 2021, but really had a tough year last year, and it was down to 10,466. The Russell 2000 is the small cap index. That was off 20%. The MSCI EFA was the international stock index. It was off 14%. The Barclays Ag was the basically the representation of the US bond market. It was off about 13%, the worst year in modern history, as bonds sold off on the impacts of inflation and rising interest rates. It was a bad year for fixed income in general. And then gold, we put this here, was down almost flat, but it was still down to 1826 per ounce at the close of the year. Usually, the consensus is that gold would go up if everything else was down, and we've seen again that that's not necessarily the case. So this just gives you a snapshot of where those indexes placed for the year. And overall, it was one of those negative years that we talk about. Even in a well-diversified portfolio, 60-40, 60% to stocks, 40% to fixed income, was negative double digit. And it was probably one of the worst years for that portfolio. It's not the reason to get out of it, but it's just part of the investment process. And one of the things you've heard us talk about time and time again is that you can expect 2 negative years out of a decade. We just saw one of them. So
I'm gonna take over this one.
Just some of the details on the indexes. Tara, take it away.
Okay, awesome. I was going to give a little bit of background on S&P 500, but I think Greg did a good job. It is one that we commonly quote and track. It's just one of the best gauges for the U.S. equities market. So Standard & Poor's, the most recent year-to-date market low, as you can see here, it's pretty obvious, was on Thursday, January 25th, and it dipped down to just over 3,800. I checked right before we hopped on. I was seeing definitely some movement. So the S&P 500 was trading slightly above 4010. And so if we look at the low to where we are today, we're up about 202 points, which puts us at about a 5% increase, which is right around where we snapped this chart. And so that's S&P 500 year to date. Let's take a look next at the NASDAQ. So the NASDAQ year to date, that's what we're looking at as well on this one. It's just another staple as far as reports that we're looking at. The NASDAQ composite comprises about 3,700 company stock. This is heavily weighted in the tech sector. And so we have seen a lot of movement this year, especially in the tech sector. You can see here that, again, we had a low on January 5th, and that low dipped us down to 10,305. We're currently trading slightly less than what we sent this chart at. Again, I looked right before we hopped on, was at 11,329. That's a little over 1,000 point difference. But that puts us at a 9% increase from the low year to date. And then the last one we're going to take a look at is the ag. This is kind of a new one that we're looking at and tracking for our webinars. Definitely not a new index. But when we talk about the ag, we're referring to the Bloomberg Aggregate Bond Index. And what it looks like, what it looks at is all of the investment grade bonds, government and corporate. The ag had a low on a different day than the other indexes. The low was at the market open this year, which was January 3rd. at 97.56. It did peak on the 18th. It is now trading close to 100, which puts us a year-to-date increase at about 2.33%.
All right. Good afternoon, everybody. As we've gone through webinars last year, we always like to kind of go over on a high level latest economic data just to give a backdrop as to where we are, where we've been, and kind of where we see things heading. And so I've got this bullet point list. Some of these are negative, some of these are positive, some of these have some negative and positive mixed in with them. So I'll just spend a brief moment on each of these just to talk through the latest data. The first one there is the housing market. And we had both housing starts and existing home sales data come out last week for the prior month. The positive is they were both down less than forecasted, but they are both down. As you can imagine, with interest rates rising as they have last year. If we look at the year over year numbers, starts are down 21% from a year ago, and existing home sales are down 34% from a year ago. I guess the silver lining there is that when you really look at prices, we haven't seen the bottom fall out of prices at this point. So there's been some price stability. And if we look back a year ago across existing home sales, prices are still up a couple percentage points from 12 months ago. So that's kind of the housing market. Retail sales, the latest report that came out for December retail sales, we did see a decline. So you may have seen some negative headlines around that. And the decline was more than expected. So expected it to be down, but it was down by a little more. We're still up by 6% year over year. So from a year ago, consumers are still spending 6% more. So it's positive that folks are still spending, and it's somewhat in line with inflation. We've kind of tracked that plus or minus a few basis points as we've gone through this last year. Industrial production, this was really a negative report that came out, the latest information. We had kind of gone through last year, 2022, on a positive note in expansionary territory as far as the manufacturing index, but that has gone under 50. And so that does signal contraction. So some negative things to report there in terms of industrial production. The next item, employment and initial jobless claims. We had the latest unemployment data that came out after the end of the year. Unemployment rate actually went down from 3.7% to 3.5%, which is a historically low unemployment rate. We have seen as well initial jobless claims. The latest weekly number was under 200,000, which is not alarming by any stretch of the imagination. That's really at a kind of a normal level from an initial jobless claims standpoint. As we go forward, it is going to be interesting to see and track layoffs and the job market, because we've been in this point where we've had many job openings, but yet we've seen some companies announce layoffs. And if we continue to see that, how does that play out? You know, are folks able that lose their job? Are there other jobs for them to pick up? And do we see the unemployment rate begin to tick up? And so all these things, it's very difficult to predict these things, but we're paying attention of it every day as we come in and monitor the news of the week or the news of the day. The next bullet point is gross domestic product, which really measures economic output. So is the economy growing based on the level of goods and services that are being consumed or purchased? And the predictions are, we haven't seen fourth quarter GDP come out yet, but all indications are that that will be positive, somewhere in the less than 2% range, 1.5% to 2% range for the fourth quarter. We finished the third quarter with a GDP of over 3%. This is an annualized GDP number. But the first two quarters, if you'll recall, were negative reports on the GDP. So the predictions are for the year, we're going to be somewhere sub 2%, but still positive on GDP for 2022. And then we'll have to see how 2023 starts. There are forecasts ranging from slightly negative to more negative to slightly positive. So we'll have to see how that plays out. But again, continue to monitor that. And then I left these last two bullet points last intentionally because I think they are really the crux of determining where we go this year. And anybody that says they know with confidence, with a high level of probability, where inflation is going to end up is kind of impossible. Based on what we've seen happen with the economy, the money that's been dumped into it from stimulus, from COVID, PPP, excess unemployment benefits, all those things. We really don't have a historical precedent for this. And so again, does inflation, one thing that we have seen, and I'll jump back just to the CPI and the PPI numbers. It has been pretty evident now that the trend on inflation has been that we have probably topped out on inflation. So the question mark from here becomes, where do we level out at? The CPI, which measures consumer prices, was not over 9% in July. And then this latest reading was at 6.5%. So we've slowly come down over the last half of the year from over 9 to 6.5. We do like to look at the PPI, which is the producer price index as well. And that measures prices that producers pay. So we kind of consider that a leading indicator to consumer price index, because hopefully producers are passing on those costs, whether they be more or less, and the consumers are benefiting accordingly, or in the case of rising prices, not benefiting. But the producer price index topped out in March of 2022 at over 11%. And this last monthly reading, it actually was less than the CPI. So it was at 6% as opposed to 6.5%. So we think that's encouraging. The PPI, that was the first time it dropped down below the consumer price index.
Yeah, just to add to what you said about not knowing, in the near term, and how difficult that can be to make a judgment or a case. You go back a year, even just 12 months ago, and what we were being told is inflation is transitory. We're not going to think about raising rates, I believe is the language the Fed used, until 2023. And it wasn't until February that Russia invaded Ukraine. And then, March, finally rates began to rise, and all of a sudden inflation is not transitory anymore. It's more persistent. So, in that span of 3 to 4 months, things changed pretty quickly, didn't it?
Definitely. And you are right. I mean, there was, going back 12 months ago, you'd be hard pressed to find somebody that predicted the rate increase and the aggressive posture of the Fed that we saw last year. Just like 18 months ago, the Fed was saying that we're, like you said, it's transitory, only temporary, which delayed their action. That brings me to the last point there with the Fed. The Fed really has a tough job. They do meet, next meeting is the beginning of February. The expectations are that we will see another rate hike. I think there's not consensus around this, but at least 25 basis points. And I think the latest news and forecasts are that that's probably where we're going to sit, I guess on the outside of things, it could be 50 basis points, but I don't think they're going to hold tight. I think they are going to continue to raise rates at this next meeting. And then they'll meet again in March, and we'll see where we go from there. I did want to call attention, though. I like this picture. The Fed is really walking this tightrope. If we look back in past history, we've kind of had this pendulum swing of rising rates and then pivot. The Fed pivot. That's the terminology we've always talked about, and stopping on the increases and then going the other way. And it's a delicate balance as we look into this year. There's been talk of, does the Fed do too much and push the economy into contraction and potential shallow recession, or are we able to kind of walk this tightrope and skate through with still positive but slower growth, lower growth? So this picture here, the U.S. economy is kind of teetering and balancing based on all of these different things: inflation rates, taxes, deficit, tariffs, money supply, and then the interest rate deal there. The Fed's is really what the Fed has its thumb on. But again, it's inflation and not really knowing exactly where we settle out on inflation. The Fed's been focused on that, and they really want to do their job from that standpoint. So I'll pass it off to Tara now.
Sounds good. I'll say it, the R word. So a recession is a significant decline in economic activity spread throughout the economy, typically lasts more than a few months. We'll see this in real GDP and income, employment, industrial production, and retail sales. So just so we're aware, a recession will begin after the peak in the economy and will end at trough. So between trough and peak on the other side, we do have expansion of the economy, and that's typically where we sit. Historically, recessions have been brief. And what we're looking at here is a recession dashboard, and this just shows us 12 different economic indicators. And these economic indicators are used to assess the risk of recession. And we've been tracking this, if you've been with us from the beginning, since we started doing the market update webinars, we're taking a look at this each and every time that we meet together. And I just like to highlight some of the things that have occurred either since the last time that we talked or since the last update. And so you can see here, as far as the indicators that have changed, and this is from August 31st of 2022. There was some updates in between, but we just wanted to highlight the end of year. And so you can see housing permits have turned cautionary. At the bottom of the page, there's an explanation of what each sign means. So green arrow means expansion, the yellow dot is cautionary, and then the X is recession. And so we can see that housing permits have turned cautionary, job sentiment has turned cautionary. Jobless claims are still at expansionary levels. If we drop down into business activity, we see the ISM orders have gone from cautionary to indicate recession. Profit margins took a big jump during this time period from expansionary into recessionary. And then the last one here that I'll highlight is the yield curve. You can see that the overall signal is for recession. And just so we're aware, this does not mean absolutely that, we're heading into a recession. On average, it has been about 3 months. You can see that obviously this time is a little bit longer than that, but just based on current conditions and looking at past recessions, the indicator has turned red up to 13 months before we actually entered or crossed over into a recession. And then the next one here is just historical recessions, and we just like looking at what the economic indicators look like at that time. And you can see in prior recessions that almost all the indicators were signaling recession. We are very, very close. We just have a few still hanging on.
Yeah, so let's talk about the debt ceiling. This is a picture in front of you going back to 1980, from left to right, showing the House and the Senate at the bottom who had control, and the presidency above that. And then the debt ceiling is the black line that has continued to rise over time. And I think it's important as we talk about this debt ceiling to realize it does not authorize new spending commitments. It simply allows the government to finance its existing obligations that previous Congresses and presidents have, they've made in the past. I think you hear a lot about this debt ceiling limit, but it's important to remember that since 1960, Congress has acted 78 separate times to permanently raise, temporarily extend, or revise the definition of the debt limit. And so those have been split across Republican and Democrat Congresses and presidents. I believe it's 49 times Republican presidents and 29 times Democrat presidents since 1960. And so our current Treasury Secretary, Janet Yellen, recently sent a letter to the Congress and to leaders that basically says that the Treasury is prepared to do all that they can to use their accounting tools at their disposal, which I believe they're called extraordinary measures. I think now is the time for some extraordinary measures that would help the government to prevent a default on its obligations. So Treasury Secretary Yellen believes that these measures should be able to be in place and be used until early June. So we do have some time, and I'm sure you'll hear this on the news. It'll be talked about probably ad nauseum until Congress acts again. And, we have seen it where governments have been shut down as well. So that's not necessarily, it's not necessarily out of the question, I guess, is what I'm trying to say on that. But we do believe Congress will act at the end of the day, just as they've done 78 times before, and we will go on to see that debt ceiling clock continue to be kicked down the road to a future time. So, the conversation is certainly unnerving for us as a team, for us as your advisors, but it is one that I believe there is remedy for, and we'll see this continue on as it has in the past. I don't think the U.S. is going to go out of business. We do have the ability to print money, as you've seen just over the last several years. And while that's inflationary and that's not good, it does, it does have a way to remedy the situation. So, we wanted to have some fun with this too. I know it's a stressful conversation, but you got Uncle Sam strapped to the rocket, and he says, "Relax. They tell me there's a ceiling that will stop me." We hope that's true, and we do believe at the end of the day that Congress will act, and we'll continue to kick this can down the road. We continue to pay attention to this. It is one of those things that I think is a big issue. And, when we look at all the things that we have control over, there's only a handful of them that we really do control. We don't think it's a reason that clients should exit a well thought out financial plan that includes investments. We do believe it is one that makes a difference on how we invest going forward. So stay tuned for further details from us in writing and on these webinars.
All right. Just wanted to give I did speak to the economy and where we stand right now, but just kind of give a summary on that in the market. As you can see there, just under economic outlook, we do have elevated recession risk right now, as Tara went through that dashboard there. And doesn't mean everything's negative and all the news is negative, but predominantly or more negative than positive right now in terms of those 12 variables that we take a look at. The lagged effects of the Fed tightening will continue to weigh on an already slowing growth backdrop in 2023. So again, high interest rates and the impact of that on all areas of the economy. And then there is a narrow path for a soft landing, as I kind of communicated there, but it really depends on the resiliency of consumers. So we started out a year ago at historically low debt leverage ratios from a consumer standpoint, and they have crept up over this last year. But is the consumer able to continue to be resilient? Remains to be seen as we go into this year. And then also just corporations with regards to the job market. Do we go through a full-scale layoff cycle? Or because of the tight job market, are we able to skate through it without, humongous layoffs that ultimately end up in reduction in consumer spending that ultimately ends up in economic contraction as opposed to growth? So those are the things from an economic standpoint. From a market standpoint, obviously, we've talked about the negative returns in 2022. Multiple contraction, that's really talking about valuation. So as we look into 2023, we're really looking and paying attention to earnings and profitability, and the market's going to be paying attention to that too. We have seen the multiples on the valuation of the market have dropped down. We were at historically higher levels. So it's positive that they have come down as we've seen the volatility in the market. And there's been, I think a lot of the trading this past year, the recession word is not new in the media. It came up halfway through the year last year. So we've had this on folks' minds. And I think in some respects, the market has traded because of that more to the negative. We do continue to believe there's volatility in the short run. As we look at the first and second quarters of the year, it's more murky the first part of the year, just because of the trending on inflation, the Fed's response to that, and as I mentioned, what do we see from the business environment with corporations, layoffs, profitability, those types of things. But that last bullet there, historically, bear markets are rare. So we're talking 2 out of 10 years are negative years in the market, 20% of the time. So it's not every day that there's an opportunity to put money in when the market is down. So for long-term investors, historically, these times have been opportunities just to take advantage of. So that's kind of our summary.
Speaking of opportunities, so we're going to shift a little bit from markets and the economy into some retirement planning and then highlight Secure 2.0. And just wanted to take a moment to bring to your attention some of the changes in regards to retirement contributions. First, if you're able to participate in your employer provider plan, 401k, 403b, through a savings plan, those contribution limits have increased. We just want to make sure that you are aware of that, and if it's within your plan in order to take advantage of that. So highlighting the 401k, 403b section, contribution limits increased to $22,500 this year. If you're over age 50, you can do catch-up contributions, so that's another $7,500. So that puts you at $30,000 for the year. If you are able to increase your contributions, and again, that's part of your plan, keeping in mind that if you do receive an employer match, just want to make sure that those contributions stretch through the end of the year so you don't lose out on that. We also have clients with simple plans, and just want to bring to your attention the limits on those have increased. So for the simple plan limit at 15,500 for 2023, and then we have the catch up again over age 50 at 3,500. For individual plans, the contribution limit on traditional IRAs, Roth IRAs, increased to 6,500. You still have the catch-up contribution if you're over age 50, and that stayed at $1,000. Also, just wanted to highlight HSAs, the health savings accounts. We do have some clients who have access to them through their employer if you have a high deductible health insurance plan, and you're able to participate in an HSA. Those limits also went up for this year. So for individuals, 3,850, for families, that maximum amount at 7,750. And then the catch-up contribution on the HSAs is at $1,000. Next, for Secure 2.0, like Greg mentioned, there's just a lot to unpack here. So what we wanted to do was just highlight a few things that we believe impacted you as our clients. And so the first thing, we're going to categorize these as the year in which they go into effect. So for 2023, this year, and you've probably heard, I think this is maybe the biggest change, or at least the most talked about change, is the RMD age. And so if you look at this chart, the year in which you were born, if you were born 1950 or earlier, you've already started RMDs, or required minimum distributions. That's the amount that you have to take out from your IRAs, your traditional IRAs, 401ks, if you're no longer working. So if you've already started taking out those contributions, you're going to continue. The big change is those that are born 1951 through 1959. The RMD age has increased to 73, and you're required to take that distribution in the year in which you turn 73. So if you turn 73 this year, you're going to be required to take a distribution from that account that requires it. If you were born 1960 or later, the RMD age is now 75. So same thing applies. If the year in which you turn age 75, you're going to be required to take distributions from that and continuing.
So if somebody turns 72 this year, they do not have a required minimum distribution.
That's correct. Yeah. So if you turn 72 this year, you do not have to take an RMD. If you turned 72 last year and have not taken that RMD for last year, because the old rules said you had until April of the following year, you have to take that RMD because of the year in which you turned 72. Hopefully that didn't muddy the waters and that answered your question.
Yeah.
Okay, perfect. Next, you see the Roth employer match. I think this is exciting. If you have an employer plan, they are now going to be authorized to offer to their employees a Roth match. And so details of that are still forthcoming, but that's something just to be aware of if your employer starts to talk about it. Let's have a conversation as to whether that makes sense from a tax standpoint, because that employer match would then be taxable income to you, but potentially could have benefits down the road. The next one is Roth SEPs and Simples. And so these are for the IRAs. Previously, contributions were only authorized to be pre-tax. So if you had a simple IRA or you had a SEP IRA, the money was going in pre-tax. And so this year, 2023, contributions are now authorized to be Roth or to have a Roth SEP or Simple. The next one is for public safety workers, and it says public safety workers, but the fine print does say for private companies as well. And this is just going to be access to penalties, or I'm sorry, access to funds penalty free at an earlier age. So for public safety workers, if you are over age 50 and you're separating from service during that year, you're going to be authorized to take funds out of your retirement plan without penalty. There's a few nuances and rules with that as well. Next is if you're terminally ill, you will have access to retirement funds, again, penalty free. When I say penalty free, that just means if you're under retirement age, or what the IRS defines as retirement age 59 and a half, you don't have to pay that additional 10% penalty. This is not to get confused with taxes. Taxes are still going to be owed if they were pre-tax contributions. But if you're terminally ill, a doctor does have to certify, and they're certifying that you're going to pass away within this 7-year time frame. You're going to have access to retirement funds early again without that penalty. And then the last one here that I want to highlight is a hardship withdrawal. Previously, if you were taking money out of a 401k, you had to certify that you had a hardship and basically had to prove to the plan provider what your hardship was. They're going to be eliminating that. It's going to be a self-certification. It's still supposed to be a hardship that you define, but you're going to be able to self-certify and have access to withdrawal funds from that retirement account early.
So that was 2023. I'm going to talk through some of these provisions for 2024. And when we were putting this together, we just wanted to highlight several of these provisions. I think the actual legislation is well over 1,000 pages based on what we've seen. So, this is going to continue to be interpreted and evolve. What we want to do is to let you know that we do have this information and we can bring you timely wisdom. And I'll start with the first one here for 2024. This one isn't good for this year. It is good for next year. So 529 college savings plans, if you have a beneficiary that has already gone to college and still has money in a 529, the Secure Act 2.0 gives the permission or provision rather to establish a Roth IRA, or if there is already a Roth IRA, to roll over the amount into that Roth IRA, $6,500 this year, whatever it would go up to next year. And the maximum would be $35,000. So if there's less than $35,000 remaining in a 529 college savings account, good news. In 2024, you can roll that over for your beneficiary and help them get started off to a great retirement savings fund. So this is an advantage, we think, and is a reason why you would not liquidate out of a 529 early if your beneficiary has already completed school. The second one is employee catch-up contribution. So at age 50 in your employer's retirement plan, if your wages are $145,000 or more, you will have to make those catch-up contributions to the Roth account. So it'd be, after tax and no benefit to reducing your wages in that respect. The third one there is if you have a younger spouse. And where this would be important is if you have a younger spouse that you think may predecease you, whether it's terminal illness, family longevity issues, or something like that, and they also have a retirement plan, an employer-sponsored retirement plan. There are new post-death options for surviving spouse beneficiaries of these retirement accounts. Have to be a spouse. And beginning in 2024, the sole surviving spouse beneficiary can elect to delay the required minimum distribution longer until the deceased spouse would have reached age 73, which would be 2023, or in age 75 if it's 2033. This new post-death option is beneficial for surviving spouses who inherit retirement accounts from a younger spouse. And once RMDs are necessary, surviving spouses can then stretch those distributions using the uniform lifetime tables for the account owner. So this creates a lower RMD than if they had made a spousal rollover or remained beneficiary of the account. So there's some advantages there if you have a younger spouse. The other one, the fourth one here, is the Roth retirement plan. So there's an elimination of the required minimum distribution for the employer plans where you have a Roth component. This is good news for savers who are putting money into the Roth. The fifth one there is emergency withdrawal provisions. And the question here is, from a planning standpoint, is do you need to make a non-hardship emergency withdrawal from your retirement plan? If so, you may be able to access up to $1,000 penalty-free from your retirement plan to be used for emergency expenses. So whereas before this, you thought of your retirement accounts as a long-term savings vehicle, now I guess you can have some short-term access in the event of emergency. Be mindful of any applicable limitations. So the example there is once per year. You can't take it out more than once per year. You can't use it until it's all paid back or 3 years have passed. So it does get a little bit complicated there. The other ones here are domestic violence situations. So if you're a domestic violence victim, you may be able to eligible to access funds penalty-free up to $10,000 or 50% of your vested balance. We also have some provisions for student loans. So you could take advantage of the newly allowed employer match on your student loan payment. This may make sense for your situation if it's permitted by your employer. Again, this is if you're employed. And then lastly, in 2024 is if you own a business, there are some provisions for you in terms of credits for retirement plans. Also, if you are a sole proprietor or your LLC is taxed as a sole proprietor, it may make sense for your business to retroactively establish a 401k. Again, this gets into the weeds, and I think it would be important to talk with us about how these specific provisions would impact your situation. There's a lot more too. So we
Yes.
wanted to give you just some of the highlights.
Yes, there is, and it goes out beyond 2024 as well.
Yeah.
So we just bullet pointed a couple things for 2025 and 2026. In 2025, if you are age 60 through 63, there's a catch up for your employer's retirement plan. So you can make some increased catch up contributions in your 401k or even your simple IRA plan. Those amounts are different, but we can address those specific amounts as we get closer to 2025. And then automatic enrollment. So if you're a business owner or part of an employee of a business that starts up a plan in 2024 or later, then employees are going to be automatically enrolled unless it's just a smaller business or falls under some other exemption criteria. But that is a new provision to employer plans. And then 2026, long-term care premium. So if you have a traditional long-term care policy or purchase a traditional long-term care policy, then there's some accommodation for being able to take penalty-free distributions from your retirement account to pay for those long-term care premiums up to certain amounts. And then finally, the ABLE accounts bullet point there. If you are disabled or your disability occurred before the age of 46, then there's some newly expanded access to ABLE accounts that could benefit planning goals. So again, those are in the future, but things that as we go through the legislation that are on our radar screen that we'll be prepared to address when they are implemented.
Okay, with that being said, we sat down, we were thinking through this, and just really the changes highlight the value of personalized advice and planning. And so oftentimes, I'll hear someone say, I heard, so-and-so was doing this with their finances, or, should I do this? And the idea is we want to make sure that your plan is comprehensive, but it is personalized to you. And so we want to address those things that are specific to you rather than just taking very, general information. And that's what happens when we come in, we sit down, for your review meetings or your planning update. A few other things that will impact your retirement that weren't addressed in this current legislation is the 10-year beneficiary designation for IRAs. At this time, so Secure Act, the first one, eliminated the stretch provisions for those non-spouse inherited IRAs. And so at this time, we're looking at for non-spouse IRAs, you have to completely deplete the account before the end of the 10th year after death. And the initial thought is we can hold off on taking those distributions and be very strategic for tax planning purposes on when to take them. The IRS has issued not very specific guidance on this. And so we were hoping that with this update, they would and verify whether or not we can do that, hold off until the 10th year, or we needed to take specific distributions during that year. So still holding on to that thought, and we'll see what comes of that. And then the last is the QCDs. So QCDs don't align with the RMD age. So those qualified charitable distributions, you can still take them at 70 and a half or still distribute them at 70 and a half. You don't have to wait until your new RMD age of 73 or 75. And as it stands right now, the legislation did not address this. So we're moving forward with being able to distribute from your IRAs, those qualified charitable distributions still at age 70 and a half.
Before we move on to the next thing, I did want to address one question that came up. Somebody submitted, are we not already seeing significant layoffs in the tech sector? Yes, we have seen those. I think that's been a trend, not just of late, but we've seen that even start towards the latter part of the year. It's just interesting that we haven't seen that play out in the numbers yet from an unemployment standpoint, or even from
Jobless claim.
the weekly jobless claims. So maybe that takes some time to play itself out. But fair point. Yes, we have seen that. And that's what we'll continue to monitor. All right. Before I let Greg close up, we do always like to end these with just a verse of scripture, some biblical wisdom. We haven't used this verse before, from Ecclesiastes chapter 5, verse 10. He who loves money will not be satisfied with money, nor he who loves wealth with his income. This also is vanity. And so, you know, we have talked with you guys about how money is a tool, but money in itself is not what's going to satisfy and bring contentment. And really true contentment comes from God as our Heavenly Father and salvation made possible through Jesus. And, you know, the world is constantly trying to tell us what will give us happiness, satisfaction, contentment. But there really is one thing when it comes down to it. And so just wanted to share that and encourage you guys in that. And we're here to talk to you about that if you'd like to. Did we lose Greg?
I think I'm back.
Okay.
I have an unstable internet connection.
Okay.
We thank you guys for joining us today, and appreciate you staying in touch, and we continue to do these. Again, if there's any way that we can help you, please let us know. And also those that you care about, your loved ones, friends, and family, please be sharing this information with them as well. We're happy to serve as your trusted advisor, and we look forward to seeing you again soon. Bye-bye.
Bye-bye.